transactions without consulting your professional, your financial advisor, and your tax professional. This is only for training and information. So what is it that we're going to learn today? Today, we're going to learn about deductions. How is it that we can use these deductions on our taxes every year? Also, the benefits of being self-employed and having a 1099, and what are the requirements for a 1099? And then also record keeping, guys, because as a business owner, it is very important that we track and that we paper trail all of our receipts and everything that we use on our tax return. So this is what we're going to be discussing today. Now, what qualifies people for a 1099? Many people say, well, I earned $200. I didn't get a 1099. Oh, well, I don't have to file my taxes. I don't have to file a business. Well, guys, that's not correct. Yes, you do need to earn at least 600 or more to receive a 1099. That is correct. But can you file a business tax return with less than 600? Absolutely. And today I'm going to show you how we can do that. But the minimum is 600, but it's not a requirement to file your business taxes. So today we're going to share with you on what is it that you can deduct as a business owner. Now, as a 1099, that is a sole proprietorship, and it could be in any kind of business. But if you do not receive a 1099, but you're still a business owner, you can still file a sole proprietorship, which is a small business. These are the deductions that you're allowed to take that will make a tremendous difference on your tax return. Let's start with the few. Mileage for your vehicle. When we use our vehicle for your business, it is a tax write-off. Now, the mileage rate does change every year. For instance, for 2022, the standard mileage for business is 58.5 cents per mile. That is huge. That's a huge deduction. But people sometimes have a misconception because when it comes to charity, it's a different rate. That's 14 cents. When it comes to medical, that's 18 cents. So just remember, for business, for this year, it's going to be 58.5 cents per mile, and it can really add up. And then I'm going to share with you guys, how is it that you can track your mileage? How about insurance premiums? If you have a business, you have your liability insurance. All insurances that are even your office insurance, your liability, any kind of insurance that you have for your business is 100% deductible, dollar for dollar from your income. It is very important that you know that, because sometimes we think, oh, this insurance isn't deductible because it's only liability. Everything that has to do with your business is deductible. How about office supplies, guys? Everything that you have for your business, even if you don't have an office, even if you don't pay rent in an office, but you have an office at home, which we're going to talk about that in a little bit. Every single item that you use for your office is deductible. Even the paper clips, guys, even paper clips are deductible. So you make sure you save your receipts. And then home office expenses. You know what happened in 2020? Many people were working from home, but people were working from home as an employee. But many people were also working from home as business owners. So I'm going to spend a couple of minutes and talk to you about the difference and how you can leverage being a 1099 recipient or a sole proprietor to write off so much more from your home versus a W-2 versus an employee. Office rent. Many people have two offices, in-home office, and then also rent a office elsewhere. That is 100% deductible. Even though you have a home office, if you're paying rent elsewhere, that is also deductible. Okay, you can have multiple offices and write off every single one of them. And then your phone, your internet cost, that is also deductible. You can even deduct your cell phone. If you have a designated phone just for business, that's 100% deductible. So you can have multiple lines. You know, I'm very, very, very old fashioned, and I didn't realize until just recently that you can have one phone with multiple lines. It just blew me away. I'm like, how can you have one phone with multiple lines? I thought that you had to have a phone for every single line. And then one of my sons tells me, Mom, you don't have to, because I have three cell phones. He says, Mom, why don't you just have one? You can have one phone, multiple lines, which I think it's an excellent idea, but you can use one line designated for business and take 100% write-off. If you have a line that is for personal use, now that we have to make an adjustment and prorate it based on the usage for the business. But I recommend, in my opinion, that you have one line designated for the business, because that'll be 100% deductible. Internet costs, guys, internet, 100% deductible if it's at an office. Now, if it's at home, we'll talk about that, because there are some changes and some modifications that we have to make for the internet cost at home. How about business travel? Can you travel all over the states? Can you travel everywhere and potentially write it off? Yes, if it has anything to do with your business. If you go see a client, if you go and do business in any other state, anywhere, you could potentially have a write-off and write off your business travel and your meals when they're associated with your business. How awesome is it to be able to travel all over and to be able to take that just because you're a business owner? That is awesome. See, if that doesn't entice you to become a business owner, I don't know what might, because I like to travel. I like to travel with my family. And especially if I know that I can write that off, it even makes it even funner to do that. And then also hotel, if you use Lyft, Uber, your flight is also deductible. But this is when you have to be very careful, because I know we like to travel with our family. And is everything deductible? Are the kids' flights deductible? It has to be business. So be careful with that, because if your spouse is in the business with you. Now, how many businesses do you know where the husband and wife are in business? Some. But let me give you an example. World Financial Group. You can have husband and wife, both in the business. Now you get to write off double. You get to write off both flights. You get to write off double because both are in the business. How awesome is that? So you know what, Mike? I don't know about you, but I'm already getting excited, because I love to know that we're making money, but we also want to save money. Because people are like, oh, I don't want to earn a lot of money for what? Then I got to pay taxes. But it's not necessarily true, guys. If you have the right information and the right deductions, it's awesome to be a business owner. Let's talk a little bit more about more deductions on a 1099. How about startup expenses? When we first start a business, we have expenses, licensing, furniture. We have applications. We have so much. How can we write that off when we didn't even earn that much money that year? You know what, Mike? Today it's good news. You get to write up your startup expenses, even if you don't show. People think that you have to show an excessive amount of income. I'm going to show you some numbers to show you that startup expenses can be deducted on the year that you start your business, even if you don't show cash flow. There is a minimum, and we'll go over those details. How about credit cards? If you have a business, you want to have a credit card. You want to have a credit card that's designated to your business. Because then if Uncle Sam is knocking on your door and he says, okay, Mike, you need to show me, what is it that you charge on the credit card? That's why it's always good to have one credit card. And the interest on that is also deductible on any loan that the business has. And that's also deductible. Advertisement, promotion. Anytime that you buy a business card, anytime that you have flyers, any kind of promotion, any kind of advertisement is 100% deductible to your business. And also self-employment tax. That is also calculated as a sole proprietorship. You pay self-employment tax. Now, good news is that part of your self-employment tax goes to your Social Security. So many people think, oh my goodness, I have to pay all these taxes. What does all these taxes go for? But self-employment tax also helps you contribute into your Social Security. And then you also have, if you have client or employee entertainment. If you host, I just saw my sharing that there's going to be a gala, that there's going to be, a team gathering. All that is deductible. All of that is, so you get to eat, have fun, and take the tax write-off. It's awesome because all of that is deductible. All of your licensing, it doesn't matter what business you're in. If it requires for you to get licensed, any state fees, all of that is deductible dollar for dollar. On the year that you acquire the expense, dollar for dollar is deductible. And then after 2020, when COVID hit, everybody went virtual, and now everybody has Zoom or any kind of virtual software. That is also 100% deductible. So all of these expenses are used and you can leverage them. Even if you're a small business owner, you don't have to be a big business. You don't have to be a corporation to take advantage of these tax write-offs. A simple sole proprietorship, 1099, and even if you don't receive a 1099, remember, even if you don't receive a 1099, doesn't mean that you cannot take advantage of these deductions. You can, but make sure you speak with your tax professional as far as the income requirement. Now, this is something that I really, really want to spend a couple of minutes with you guys. And hopefully at the end, we have a couple of minutes so I can answer some questions. But on the home office deduction, this is one that many people, especially because of shelter in place, many people work from home. But if you're an employee, unfortunately, you cannot take these deductions because your employer is supposed to reimburse you for the equipment, for your internet, and the employer takes the write-off. The business owner takes the write-off. As an employee, you don't. But what happens if you engage in a small business? What happens if you're a business owner now and you, because of COVID, you decided to open up an office in your home? Well, this is what you can use to take that credit. Now, let's rewind a little bit. Back in 2018, we had the tax reform where many deductions were eliminated. One of them, or not eliminated, but it was very difficult to hit those numbers. For instance, if you itemized, you were able to take your mortgage interest and your property taxes, and you had all of those deductions. And it was very easy to itemize. But after 2018, it was very difficult because now for a married filing joint, just an example, for married filing joint, in order for you to itemize, you need to exceed 25,100 of deductions. Well, I know that in the Bay Area, it's very easy to pay 25,000 in interest on a mortgage, but I'm talking about Madera, California, Central Valley here. It is very difficult and it's not as common for someone to reach that number. But guess what? Even though you don't itemize, you can still write off your mortgage interest and your insurance and utilities and repairs because now you have an in-home office. You can use that as to calculate your credit. Also depreciation. Now, what is it based on? It's based on the percentage that is devoted for your home. Now, some people think that, okay, I have one room. It's 300 square feet. That's all I have. That's all I'm going to use. But that's not necessarily true. If you have meetings in your living room, now you can take that square footage. You have your office. How about if now you have meetings in your kitchen and we have proof that we have meetings in the kitchen, we can take that too. So now the square footage is increasing, but we have to have proper paper trail and proof that we do use all that area in your home. How much of it can you write off? Well, it's based on the square footage and it's also based on the expenses that I mentioned on the top. But let's say you don't want to do the itemization and you just want to do the standard. IRS allows us a standard. If for 300 square feet or less, you can just opt out and take the simplified deduction. IRS gives us $5 per square foot. That's standard. If you do not want to itemize, if you say, you know what, I just want to take the standard, that's $5 per square foot. It can add up, guys. That would be the standard deduction that you would take on your sole proprietorship 1099 business income. It's a deduction. Now, we all know that also in the 2018 tax reform, we lost our exemption. What does that mean? What is the exemption? Well, we used to have an allocated amount, $4,000, $4,500, and every year it does change, an amount that you will be able to deduct for your children. or for yourself as a taxpayer, you were able to deduct a certain amount, which it was a substantial amount. Well, that was also eliminated in 2018. But guess what? As a business owner, now you can hire your kids and pay them that amount that you would normally take on your taxes, that $4,000, $5,000, whatever it is. Now you can hire your children and take that deduction. And now it's also going to help you on your business. So let me explain a little bit. So you must make sure that your child is a real employee. Chores and allowances does not qualify as an employee. This means that the child has to have a role in the business. Now, the child has to have reasonable wages. And you cannot put a chore in place of the business. The child has to actually do something for your business. So let me give you an example. So let's say you have an 8-year-old and you need somebody to shred paper for you all day long, or just a few hours, maybe 5 hours, 3 hours, 2 hours, whatever it is in your office. That 8-year-old can be on your payroll. But it has to be where he clocks in, he clocks out, or she. You should keep accurate, complete payroll records, because your child is an employee of the business and you do not have to become a corporation. I know some of my clients have asked, Yesenia, I found out that, or I thought that we had to be a corporation in order to hire our children. That is not true. As long as you are a business owner and you're running payroll, you can add your children onto payroll and take that deduction. Now, the wages need to be deposited. If you make a check out to your daughter for, let's say you pay them $1,000 a month, those $1,000 need to be deposited into an account that the check is actually cashed. You cannot hold that check. It has to be cashed. Now, you can help if they exceed the standard deduction, your child will have to file. But you know that the standard deduction for a single person varies, but for the most part, it's $12,000. This year it's going to be $12,550. So if you comply with all the labor laws, and as long as you do not pay them over the standard deduction, guess what? The child does not have to file taxes, but you get to take that deduction dollar for dollar off of your income, and that's tax-free money to your child. Just do not exceed the standard deduction of a single person. Separate family and work jobs. I cannot stress enough how important it is that family chores at home that does not qualify as an employee. And they have to do age appropriate tasks. If you have a 1-year-old and you say, oh, my 1-year-old is going to be my janitor, well, that's not going to quite cut it. But hey, I have a client that he is in advertising, and he uses his 2 little girls as models. And he uses the little girls as models. So now the little girls, he uses them for advertisement in his business. And so he put the babies in on payroll, but that isn't age appropriate. So it doesn't specify, it doesn't matter how old they are, as long as the task does and will be justified with their age. You can use it as a payroll. Now, I know that we have so many regulations, especially in the state of California. Well, the FLSA sets at 14 years of age is the minimum age to be able to hire someone. But as you can see, many states also require that you're at least 16 to get a work permit. All of these rules are correct, but I'm telling you that there are exceptions, and IRS allows us legally to hire our children even if they're under the age of 14, under the age of 16. Now, if the income does not exceed, like I said, their standard deduction, you do not have to file in their taxes. Now, workman's comp. Workman's compensation is something that we must have for all of our employees. As you can see, every state varies. And this is something that you need to verify with, depending on what state you're in. This does change. But for the most part, you need to have all of your workman's comp, and you need to have everything in place, even if it's for your children. Now, what happens with that money? I'm just going to give you a recommendation that I give all my clients. We're like, okay, Yesenia, so I paid my kid $10,000. I'm not going to file taxes. I took the $10,000 deduction from my sole proprietorship. What can I do with that money? And keep it tax-free. Because remember, right now, if you don't exceed the standard deduction, all that money is tax-free. So my recommendation is that you still keep it as a tax-free investment. So if you invest into a Roth IRA, kids can contribute into a Roth IRA. The only thing is that they have to have earned income. They have to have earned income. And they can also, as long as we have, as long as they have earned income, you can open an IRA for them. And it's $6,000 a year that you can invest. That was for 2022. Like I said, the amounts change, but it's been this way for a while. $6,000 is the annual contribution that you can put into a Roth IRA. Now that money is continuously growing, and it's a tax-free. It's a tax-exempt investment. So the money still keeps on growing without having to pay taxes, but you can pay them up to the standard deduction, not exceeding. How exciting is that? To be able to hire your kids. You don't have to wait until they're 14. You don't have to wait until they're adults. You don't have to wait until they're 16. As long as they have an age-appropriate task in your business and you are running a true payroll and you're tracking the hours, the clock in, clock out, and file the proper reports with the IRS and the state of California or any state that you're in, then it is deductible. It is 100% deductible. One of the credits that I want to talk to you about today, also as a business owner, is the ERC. The ERC is an employee retention credit. These are for businesses that already existed after or were impacted after March 12th of 2020 when COVID hit. The ERC is part of the CARES Act. Now, many people really thought that credit expired after 2021. I got news for you guys. This credit is still available for people that didn't claim it in 2021 taxes. And you can also, I'm going to talk to you on how you can do an amended return and gain that credit back. And I'm going to show you as business owners, if you were in business in 2020, why was this credit? Why was it enforced after the CARES Act? And it was simple. It was because it was to encourage businesses to keep their employees in payroll. Many people put their employees on unemployment. Unemployment skyrocketed all over the United States. Well, the ERC credit was for employers to keep their employees. Now, who qualifies for the ERC? And remember, even though this credit was for 2021, there's still time to claim it if you were a business owner in 2020 impacted by COVID. You can still claim that credit. So who qualifies? Any business that has less than 500 employees. And this is a payroll tax credit based on W-2. And the gross receipts have to be down at least 20% per quarter. So if you qualify even for one quarter, you're eligible for the credit. But we have to show a 20% reduction. And the credit is for a maximum of 10,000 wages per employee per quarter. If your wages exceed 10,000 per employee per quarter, then the business owner cannot take the ERC credit. So I'm going to give you an example because I know all of this stuff is like, okay, Yesenia, but what does it mean? Talk to me in money. Talk to me in dollars so I can have an idea of how impactful the ERC credit is. I want you to see that being a business owner has so many advantages, so many advantages. The ERC credit works like this. So let me give you an example. Let's say you're a business owner and you were in business in 2020. After March 12th of 2020, and you were impacted, by COVID, like every American was. Let's say you had 4 employees and each earned $1,000 a month. Simple math, guys. That is $4,000 a month. So if you multiply the 4,000 by the 3 months, that's 12,000 per quarter. The ERC allows you to gain 70% of your quarterly wages. You multiply that by 70%. That's how huge this credit is per quarter. So that's 8,400 ERC per quarter. So if you multiply that by 4 quarters, you as a business owner can potentially gain $32,600. And that's with an employee that earns only $1,000 a month. So this credit is still, you can still get it. How can you still get this credit? Well, it has to be through an amended return, and it has to be it goes through your 940s, which are your payroll tax returns. And then you would have to do an amended return to be able to regain this. So if you're a business owner now and thought that, oh, I missed the boat, I did not claim my ERC credit back in 2021, I want you to know that you can still gain that today. And this is how it works. So get a hold of your tax professional, let them know that you want your ERC credit because it is a substantial. Now, this is real money, guys, real money that the IRS has to help business owners that kept their employees. Now, if the employees were your children, there's some other rules or regulations. Just make sure that you ask your tax professional about that. So far, so good, guys. I don't know about you, but I'm still excited. I'm still excited because all I see is money. All I see is tax deductions. All I see is how awesome it is to be a business owner. All I see is that, hey, the IRS is not that much of a bad guy. And all I see is that I don't have to have my stomach in knots every tax season. Because there's hope, guys. There's so many things that we can do to be able to reduce our tax liability and to be able to keep more money in our pockets. Right, guys? Okay, I want to see a bunch of thumbs up. I want to see a bunch of thumbs up. All of you guys that are excited and see hope, I want to see a bunch of thumbs up because that shows me you guys are listening. I know many of you haven't had your coffee, but that's okay. This is good stuff, guys. So awesome. Thanks for the participation. So this is the form that I just wanted to show you, the form that you can use to claim that. It's a 5884A. If you don't have a tax professional and you do your own taxes, this is the form that you would do to calculate it. And then you would have to do the amended returns that I spoke with you earlier. So remember, this is the one that you can claim the ERC credit is the 5884A. So now what I want to do is I'm going to spend a couple of minutes. Everything that we talked about right now, I want to show you what it looks like on a real tax return. I have a Mr. A and a Mr. B. Now, you know what makes it so cool about Mr. A and Mr. B story is that these guys really exist. These guys really exist. Mr. A and Mr. B are my real clients. But of course, all that information you see on here, I hit all their personal information, but Mr. A and B do exist. And everything that we talked about today, I'm going to put it on a case study so you can visualize in money, in dollars, the difference between applying the knowledge. Because many people say that knowledge is very powerful. I agree, but applied knowledge is even more powerful. So today I'm going to show you the difference between a person that knows their tax deductions versus a person that doesn't. And like I said, these two guys, they exist. So this is Mr. A. Mr. A is a single parent. He has one child and he works at a factory and his income is $82,000 a year. He's on a salary. Now, Mr. A doesn't like to give a penny to Uncle Sam, not even during the year. So guess what? He listened to his friends and his friends told him that on the W-4, which is how you can determine how much taxes they're going to withhold from your payroll, he went exempt. What does that mean? He says, I don't want any federal taxes withheld. I don't want any state taxes withheld. I want to keep all my money. And then when they asked Mr. A to join a business, he says, no, I'm too busy. I don't want to join a business. I'm happy just working. I work from 9 to 5. I go home. I keep all my money throughout the year. I have my daughter to take care of. I don't want to join a business. I don't want to do anything. I don't want to listen to no tax strategies. And this is what he did. And this is a real tax return, guys. So as you can see, 82,000 with his income. Now, his taxable income, and I need you to, if you guys can write these numbers down, because when I do these case studies, if you guys write these numbers down, things are going to make sense to you. So if you can see on the taxable income, his taxable income is 63,200, right? Why? Because as a head of household, you get 18,800 deduction from your income. So that's how we came up with 63,200. That's his taxable income. But if you can see, he had no taxes withheld, not 1 cent on his W-4, not 1 penny he had deducted. So guess what? This is what he owes. $5,206. He was not a happy person. He's the kind of client that has stomach aches walking into my office and walking all the way to the parking lot. And I think he had a stomach ache all the way home because he owed $5,206. Now, his best friend works with him, and this is Mr. B. But his best friend is very coachable. And he says, I don't like to pay taxes. I want to learn. And he went and he got the knowledge. And he says, you know what? I am going to apply everything I hear. Of course, he runs it by his tax professional. And he says, I am going to do things differently. So when he found out, when he sees that Mr. A is not being coachable, then he did things different. This is Mr. B. Mr. B is also a single parent. He also has 1 daughter. And guess what? He also earns $82,000 a year because they work in the same company, in the same department, doing the same job. And if you can see, there's a difference here. There's a difference here with Mr. B. There's a deduction, $13,836. I'm going to show you how he got that in a couple of minutes. So if you see his taxable income is $49,364. Do you guys see the difference? Already, we haven't even finished the case study and you can already see a difference. Now, if you look at line 20A, he still has the same standard deduction of $18,800. Same deduction. The only thing that's different is if you look at line 8, the credit or the deduction of $13,000, I'm going to show you how he came up with that. Mr. B opened a small business. He decided to help families. He wanted to go in the business where he helps families, where he gives people, solutions, financial solutions. He decided to help families, and he earned $12,000 in that year, part-time, part-time, because he wasn't that as busy as Mr. A was very busy. He said he didn't have time for a business. See, Mr. B wasn't that busy. So he says, I'm not that busy to get educated. I'm not that busy to create a future for my daughter. So he started this small business. As you can see, there's 2 deductions that I'm going to highlight on this form, which is the Schedule C. He hired his daughter and he paid her $9,600. And as you can see, he wrote off the $9,600. Daughter did not have to file her tax return because she did not exceed the standard deduction. But then look at line 30. Mr. B also had an office at home. His deduction was $8,744 just for having an in-home office, plus other deductions that you see is how we came up with the $13,836 loss on the business. So did he pay taxes on the $12,000 that he earned helping families? No, he didn't. Did he have to pay taxes on the $9,600 that he paid his daughter? No, he didn't. Did the daughter have to file taxes? No, she didn't. Now, as an employee, was he able to write off the internet, the cell phone? And absolutely not. But guess what? Mr. B did, not $8,744. Now, Mr. B had taxes withheld from his salary. That was a $7,555 federal withholding that he had from his wages. from his wages. So if you look at that, plus if you look at the credit that he has a refund of $4,914. This is two individuals with the same identical income, same filing status, same dependents. What is the difference? I want you guys to put in the chat, what do you think the difference is between case study A and case study B? How impactful is it to really know your tax deductions, to really leverage being a business owner? What do you think the impact was? How sad do you think Mr. A is? Do you think that he just lost $4,914? What do you guys think? How much money do you think Mr. A lost for not leveraging a business? This is the amount, guys. This is the amount that he lost for not being a business owner. I don't know about you guys, but to me, that's a lot of money. What do you think, Mai? Would you be as shocked? Look at this. Look at this poor guy. He is just so shocked because it's the same income, everything identical. But look at the impact. Those $10,000 can go towards anything for your family. If a year by year by year, if you use compound interest and you invest this money, how much more money would he have for his daughter year by year by year by investing it in anything else versus giving it to Uncle Sam? So this is why I tell you that it is so important that we understand the difference between tax deductions, employee deductions, business owner deduction, and how you can leverage having a small business to change the whole results of your tax return. Now, I know everybody's all excited and shocked. I want you guys, I only have a couple of minutes left. I want to spend a couple of minutes with record keeping because IRS, I just had an opportunity to spend a whole week with auditors from the IRS, and there's going to be some changes this year, guys. We have a lot of changes coming up for 2023. One of the things is that IRS has hired hundreds and hundreds of new people. They're back. You know, they took a 2-year vacation, they're back. And this is what they're looking for. They want receipts that are visible, receipts that you can read. If you get a receipt that is all crumpled up and it's all, faded away, they're not going to accept it anymore. They're going to totally disregard it. So one of the things that I recommend is that you scan your receipts. Or if you have like I mentioned to you earlier, if you have a business credit card, you can use that credit card and keep those statements. That way there's no risk of you losing those receipts. Now you can use any kind of software to track your business, something that clearly tracks your income and expenses. That's simple, guys. Income and expenses. And we recommend that you keep your taxes for 5 years and all of your record keeping for 5 years, because that's the statute of limitations. IRS can go back 5 years. Now, isn't this crazy? For you to claim a refund or for you to amend your taxes, you got 3 years. But IRS has 5 years to come back and say, hey, you claimed all these deductions. I need receipts. And how about if we don't have them? Or how about if they faded? Too bad, so sad. They're like, it doesn't matter. You can't take it. So make sure that you keep it. Track your mileage. Track your mileage. You just cannot say, well, I think that I used this many miles. Or I think that I think doesn't work anymore, guys. They want to see paper trail. Now, this is just some recommendations of softwares that many of my clients use. You can use anyone. I just wanted to show you that Mile IQ. These are just some of the softwares that you can use to track your expenses. But if you don't want to use any of this, just as long as you have paper trail, you keep all your receipts and income broken down by year, by month, by quarter, whatever works for you. that is going to keep you out of trouble. Keep everything for 5 years, keep it in a safe place, and you should be okay with the IRS. They should leave you alone for that. And lastly, if you do claim an in-home office, make sure that it is an in-home office. Last year, 2 of my clients, IRS, without any, they said they didn't have any notice. IRS says that they sent them a notice, but they knocked on their door and they asked them if they could please review and verify that they did have indeed an in-home office. So if you're going to claim an in-home office, we cannot have a bedroom set in there, guys. We cannot have a bedroom set. It cannot have a closet. Those are the 2 things that IRS is looking for. No bed, no closet. If you don't even have a desk and you have a box, that's okay. Just no bed, no closet, no wardrobe in the closet. As long as you have and it looks like an office and you have some kind of equipment, IRS will accept it. But if there's a bedroom set in there, they will disallow it 100%. So make sure you guys are careful with that and keep your records and have an awesome, every tax season should be awesome for you guys. And especially if you're business owners, take advantage of all the tax deductions that the IRS gives us. This is the resource that everything that I went over today. If you want to confirm, verify, everything this is the website, the www.irs.gov. Everything that I used in my presentation today, it was all from the IRS website, all the publications. You guys can always reference to that. That is the safest place to get your information so you don't have any misleading information from anybody. And with that, that concludes my presentation. If we have a couple of minutes for question and answers, it's up to you. I'd say it back to you. Thank you, Mai, for giving me, and thank you. Thank you for allowing me to be here. Thank you, Min, for allowing me to be here and to be with all of you. It is an honor for me. It's a privilege to me to be associated with an organization like World Financial Group, an organization that believes in helping families and educating families and truly believing in people and showing people that there is a better way. So it is my honor to be here. Hopefully I get invited again. Thank you so much. And we have a couple of minutes for some questions.